Hi, my name is Mel Giannone, President and Broker of Record here at Paramount Real Estate Properties, headquartered in the Greater Toronto Area. We specialize in the exclusive representation of tenant occupiers and investors of commercial property. And you're someone in my marketplace I'd like to do business with. You can check us out by clicking the link to our latest real estate podcast called CRE Next, Work Out Loud, where we share helpful insights on commercial real estate matters affecting you and your business.
Mel, how do you evaluate your commercial real estate deals?
So evaluating my commercial real estate deals. Now, I'll take this from two perspectives. If I'm working on an assignment on behalf of a client, I have to determine the opportunity cost of engaging with that client on the assignment. Does it pay to work on this assignment, given the opportunity cost of taking my time, which is the commodity that I have, and deploying it somewhere else where I would get a greater return. Similarly, in a different perspective, in a different vein, from an investment point of view or a deal point of view, I would look at the opportunity cost of pursuing this particular property or asset versus some other type of asset. Now, a property is just like a stock, so hopefully the property will appreciate in value just like a stock does, and a property spits out a dividend in the form of cash flow just like a stock does. However, a stock could easily be traded, it's liquid. A real estate opportunity is less liquid. So you have to determine, am I better off in a risk-free bond where I just put money in and just collect a coupon and clip it out every month, or pursue a real estate deal? Now, let's say I've gone through that and the opportunity cost is, hey, I can get a greater return here with some form of acceptable risk in the real estate deal. So what happens next? Well, at that point in time, you've got to do your due diligence, right? This is where you have to start crunching some numbers. And you don't really go into it all in right from the outset. You're trying to do something just gradual, back of the napkin, the math. For instance, what are my borrowing costs versus what my potential returns are for this asset. And if it makes sense, you then go to the next level. Okay, it's got my attention. I'm pretty compelled to move forward. Why don't I go see the actual asset itself and see what kind of physical condition it's in and gauge whether or not this is something that belongs, let's say, with my thesis. So I have a strategy, I have a specialty that I focus on. Would this align with my strategy? Would this align with my thesis? So I go and I do a walk around, look at the physical attributes of the building, see where it sits in the market, see how it services the needs of that community, and determine at that point, are there any risks involved with the actual physical side of the asset? And also, where is it located? Is it a great location, or is it just a mediocre location? Because that'll determine whether or not you're going to get appreciation, or you're going to have a hybrid situation where you get appreciation plus cash flow, which is what we were talking about in the outset. So once you do that physical due diligence, you then go back and say, all right, well, it passed that sniff test. Let me go back and start doing some real number crunching. But with that, I have to ask a bunch of questions to everyone who's involved. It could be the listing broker on the other side. Ask them a ton of questions, sniff out as much information as you can. Ask the property manager that manages that property. What are the problems with the property? How do you find the tenants in that property? Is it tough to manage? Is this, real easy to manage? And do you foresee any problems happening in the next 3-5 years? And then you might actually want to talk to the owner and say, okay, why is it that you want to sell? What's your motivation for selling? And then eventually, once you get a good picture of what you're dealing with, you can go back to your investors and then run the idea by them. This way I look at it, this is a great looking location that sits on 1st Street and 2nd Street, and it services a huge community. The demographics of that community actually serves well for this type of asset. And from what I can gather, we can get the returns that are in line with some of the other returns in our niche or in our specialty that we focus on. So from that point on, you use that as a sounding board. If you get everybody on board, then you know that it's a pretty good investment opportunity, not only for yourself, but for your partners who are already kind of swayed into investing into this thing. So from that point on, you go and do some financial modeling. And that means you have to take the assumptions of the marketplace and the information that you've got from those other parties, put it into a financial model, come up with a 5-year plan or a 10-year plan, and see whether or not this particular investment will deliver the returns that you have set for yourself. Let's say you want to have a 20% internal rate of return for all my projects, which is pretty ambitious these days. But let's say that is the target. And if you've done the modeling and it turns out, yes, it is possible to do this, and I don't have a slim margin of error where it could throw me into a panic situation where I could default, then you've got the green light to go ahead and submit an offer. And hopefully you negotiate the deal that works for everyone involved. So that's how I go about doing that.